Rates on focus on both sides of the border in Canada. We made a rate decision, keeping rates unchanged at around 5%, but definitely opening the door to talking about rate cuts, with Tiff Macklem saying it's within the realm of possibilities. Meanwhile, south of the border, we saw inflation creep higher, and this has been a game of reducing the number of rate cuts for much of 2024. Is Canada and the U.S. set for a diverging path when it comes to rates? Let's bring in Francis Donald, Global Chief Economist and Strategist at Manulife Investment Management. Francis, thank you so much for joining us. It's looking increasingly likely that Canada will be the first to cut rates if it's a choice between Canada and the U.S.
If that was the choice, I feel like I have whiplash, Amber. We start the morning with this very hot, sticky CPI number in the U.S. The market says June is out for the Federal Reserve. September is a much more likely play, and that's probably what most of us have to do with our forecasts. And then Tiff Macklem comes in just an hour and 15 minutes later and basically says, we're on track for June cuts. And not just we're on track with June cuts, but we're really happy with the inflation outlook. So right now, as it stands today, it looks like the Bank of Canada is much more comfortable moving forward. But I'm going to put an asterisk on that and say that we haven't heard from the Federal Reserve yet. They may still come out. There's a lot of Fed speak tomorrow and say this was another bump in the road, or we see reasons why we should look through it, or we're not even looking at CPI. We're looking at core PCE measures. So we're holding off from making formal changes to our Fed call until we hear a little bit more about the Fed interpretation. And that's the really big problem with being at this stage in the cycle. It's not exactly what the data says. It's how the central bankers are going to choose to interpret it.
Well, that's a good point, and maybe why the Fed minutes, which are so backward looking, are being overlooked, because there was that sentence there that most did feel it was appropriate to start cutting rates this year.
And, you know, we have a saying on my team, when the Fed starts cutting rates, you won't be asking why. We've been saying that for years, and yet in December, when the Fed pivoted and started talking about, you know what, we might see rate cuts on the horizon, we couldn't quite wrap our head around why that might be. Inflation was still strong. Growth was still strong. And so this morning we get this print coming through that says, no, you don't have the conditions to cut just yet. And yet the Fed says we want to possibly have that soft landing. Even if the data isn't 100% supportive, we want to land the soft landing. If they keep saying that, they're going to push back against this rate cut expectations. They're going to say June is still on the table. We really have to hear from them. You know, Amber, it's not uncommon for central bankers to suddenly pop up on business shows like yours to have an intervention. And when we have moves like we had today, these are really big moves in the bond market. It wouldn't surprise me if we see some sort of spontaneous commentary come through in the next few days.
And what would that job owning look like? What would they be trying to achieve if what's happening in the bond market right now is worrisome?
If the Fed wants to cut in June, that they're worried about a retightening via the bond market, they can say, look, when we look at 6-month annualized CPI, X inflation, it's or X shelter, it's down near 2%. They can say, hey, listen, one of the big reasons that CPI came in hotter in the United States today was because of things like auto insurance. Why would we hike or cut based off of a narrow column like auto insurance? You can come up with 100 different ways to frame this inflation metric. If they are really afraid of what's happening on the employment side of the picture, and yes, there are problems on the employment side of the picture in the United States, then my view is, you know what, they're going to find reasons and excuses to cut.
What about the probability that there's no cut at all? And I'd love to know what those problems are with the employment picture in the U.S., because the headline number looks robust. GDP looks robust. We know inflation is robust.
So you got to look below the surface. 303,000 jobs added in the United States. We found that out on Friday. But if you look at full-time employment in the United States, it's actually negative over the past year. Temporary employment is still signaling a recession. All the hiring activity is signaling downturns ahead. So that headline number is not giving us a good sense of where the momentum is behind jobs. And that's the really big problem that the Federal Reserve is facing, that the Bank of Canada is just not. The Federal Reserve is facing deterioration ahead in this labor market and inflation that is still strong. They have that dual mandate. The Bank of Canada only has one mandate. It's inflation, and it's going directly back towards that 2%. And that's why the Bank of Canada has the luxury, the freedom to begin cutting as early as June, and we think they will, and why the Fed is going to have to do a lot more job owning and explaining the rationale. And I feel for Chair Powell here, because there's no way he's going to satisfy everyone. Some will blame him for going too early. Some will say he's already gone too late. He cannot win.
Let's put this in the context of what this will mean for the Canadian markets. I mentioned that Canadian dollar selling off now to the lowest level in a couple of months, around 73 cents US. I guess if the divergence exacerbates in monetary policy, could we see further weakness in the CAD?
I get this feedback a lot. So if the Bank of Canada moves or cuts rates before the US, are we going to see the Canadian dollar weaken? Well, actually, markets have already incorporated that outcome. So if that is actually what happens, we wouldn't expect substantially farther deterioration. I also think it's important to recognize that the Canadian dollar doesn't just move off of the next meeting's divergence. It tends to be what's expected over the next 2 years or 5 years. And the Bank of Canada actually orchestrating more of a soft landing or moving preemptively, preventing something that's much worse, may actually reduce the amount of times they have to cut over the next 2 years. Whereas our concern in the United States is the longer the wait, the faster they have to go. So it's really balancing what the next 2 years of rate cuts look like. And in our forecast, even though the Bank of Canada is going earlier and might have to go a little bit more, they're probably going to be fairly well matched over that 2 to 3 year horizon. So rate differentials alone in the near term aren't enough to say we got to be super bearish the Canadian dollar.